Welcome and thank you for joining in. Today, we are going to dive into one of the most powerful tools you can use when trading Bank Nifty. We will focus on how to effectively use the volume indicator, which can give you a huge advantage when it comes to spotting trends, breakouts, and reversals in this very popular index. Stick around because by the end, you will not only understand how volume works, but you will also be able to use it confidently to improve your own trading strategy. Before we dive in, imagine having a tool that tells you whether a price movement is backed by real strength or if it's just a fleeting moment. That is exactly what the volume indicator does for you. So let us start by talking about what the volume indicator is and why it matters when it comes to Bank Nifty. Have you ever wondered how many shares or contracts are actually being traded while you are looking at price movement? That is exactly what the volume indicator shows you. Volume is a measure of how many shares or contracts were traded during a given time frame. This might seem simple, but it is incredibly powerful. In Bank Nifty, volume helps you confirm whether a price movement is strong or weak. This can make a big difference in understanding if a trend will last or if it might fall apart. You see, Bank Nifty is highly liquid and can move very quickly. Volume is one of those key pieces that helps you figure out if a move has strong support from the market or if it is just a short-lived blip. Another important aspect to understand when analyzing Bank Nifty is the role of chart patterns and how they interact with volume. Chart patterns are visual representations of price movement that traders use to predict future movements. When these patterns are combined with volume analysis, they become even more effective. Let us go through a few common chart patterns and see how volume plays a role in confirming them. The first chart pattern to discuss is the head and shoulders pattern. This pattern is a reversal pattern that typically signals a change in trend direction. The pattern has three peaks, with the middle peak being the highest, forming the head, and the two outer peaks forming the shoulders. When the price moves from the second shoulder and breaks through the neckline, volume plays an important role in confirming the breakout. Ideally, you want to see increasing volume when the price breaks below the neckline, indicating strong selling pressure and a reliable reversal. Another key pattern is the double top and double bottom. The double top is a bearish reversal pattern, while the double bottom is a bullish reversal pattern. In a double top, volume tends to decrease as the price approaches the second top, indicating weakening buying interest. When the price falls below the support level, you want to see an increase in volume to confirm the bearish reversal. In the case of a double bottom, volume should ideally increase as the price moves away from the second bottom, showing strong buying interest and a potential trend reversal. Triangles are also very common patterns that traders use, such as ascending, descending, and symmetrical triangles. For ascending triangles, which are typically bullish, volume tends to decrease during the consolidation phase and then surge when the price breaks above the resistance level. This surge in volume is a sign that the breakout is supported by strong buying interest. For descending triangles, which are bearish, volume should increase when the price breaks below the support level, confirming the downward move. Symmetrical triangles can break in either direction, so it is important to watch for a volume spike in the direction of the breakout to confirm the move. Another useful pattern is the flag or pennant. These patterns usually appear after a strong price movement and indicate a period of consolidation before the trend continues. Flags are typically rectangular, while pennants are more triangular. In both cases, volume tends to decrease during the consolidation phase and then increase when the price breaks out in the direction of the original trend. This volume confirmation helps you determine whether the trend is likely to continue after the breakout. Lastly, we have the cup and handle pattern, which is a bullish continuation pattern. The cup forms as the price gradually declines and then rises in a U shape, while the handle is a smaller consolidation that occurs after the cup is formed. When the price breaks out of the handle, a spike in volume can confirm that the bullish trend will continue. Without this volume confirmation, the breakout might be weak and could lead to a false signal. By understanding these common chart patterns and how volume interacts with them, you can significantly improve your ability to predict future price movements in Bank Nifty. Volume acts as a critical confirming factor that helps you validate these patterns and make more informed trading decisions. First things first, let us set up the volume indicator so you can get ready to put all of this into practice. Depending on your trading style, you will need to choose the right time frame for your charts. If you are trading intraday, shorter time frames like 5-minute or 15-minute charts are often very useful. On the other hand, if you are more into swing trading, then 1 hour or daily charts may give you the bigger picture you need. The key here is to match your time frame with your trading style, and then set up the volume bars on your charts. You want to see green bars and red bars that show the volume for each time period. Green bars indicate that price moved up during that time frame, and red bars mean price went down. These colors make it easy for you to quickly see if the market is moving up or down with volume behind it. Now let us get into reading the volume itself. This part is really where things get interesting. Imagine that you are watching Bank Nifty and you see the price rising while the volume is also increasing. That is a strong signal that the uptrend is solid and will likely continue. On the other hand, if price is going up but the volume is dropping, this is a warning sign. It might mean that fewer traders are buying in and the move could lose its strength. And if you see the price falling with high volume, this usually confirms that a strong downtrend is in place. The sellers are in control and the drop is likely to keep going. Paying attention to these volume patterns can help you avoid getting caught in weak moves and help you catch the stronger ones. Let us expand further by discussing some common chart patterns and how volume can enhance your understanding of these patterns. Understanding volume along with chart patterns can provide more context and a higher level of confidence when making trading decisions. The first chart pattern we will discuss is the bullish flag pattern. The bullish flag typically forms after a sharp upward price move and is followed by a period of consolidation that resembles a flag. During this consolidation, volume often decreases, showing that traders are pausing. When the price eventually breaks out of this consolidation, a surge in volume is crucial to confirm that the uptrend is continuing. Without this surge, the breakout may lack the conviction needed to sustain a strong upward movement. Next, let us look at the bearish flag pattern, which is the opposite of the bullish flag. This pattern forms after a sharp downward price move and then consolidates in a rectangular or slightly upward sloping flag. During the consolidation, volume should ideally drop, signaling a temporary pause in selling pressure. When the price breaks down below the flag with increasing volume, this suggests that the sellers are stepping back in with force, and the downtrend is likely to continue. Another important pattern is the rising wedge and falling wedge. A rising wedge is a bearish pattern that forms when the price makes higher highs and higher lows, but the trend lines converge. Volume usually decreases during the formation of the wedge, and when the price eventually breaks below the lower trend line with increasing volume, it signals the start of a downtrend. Conversely, a falling wedge is a bullish pattern that forms as the price makes lower lows and lower highs, and the trend lines converge. Volume tends to drop during the wedge formation, but an increase in volume during the breakout above the upper trend line can confirm a bullish reversal. We also have the rectangle pattern, which can indicate both continuation and reversal, depending on the context. A rectangle pattern occurs when the price moves sideways between a defined support and resistance level, creating a box-like range. When the price breaks out of the rectangle with increasing volume, it confirms the direction of the breakout, whether up or down. A breakout on low volume, however, may indicate a false move and potential reversal. Another useful chart pattern is the ascending channel and descending channel. These channels form when the price trends between two parallel lines. For an ascending channel, which is typically bullish, you want to see volume increasing as the price moves higher within the channel. When the price breaks above the upper channel boundary with a surge in volume, it often signals the continuation of the bullish trend. In a descending channel, which is bearish, increasing volume during downward movements confirms the bearish bias. A breakout below the lower channel line on high volume usually indicates further downward pressure. Lastly, we have the rounding bottom and rounding top patterns. A rounding bottom is a bullish reversal pattern that forms gradually, resembling a bowl shape. Volume typically decreases during the formation of the bottom and starts increasing as the price begins to rise out of the rounding formation, confirming that the buying interest is returning. On the other hand, a rounding top is a bearish reversal pattern that forms in an inverted bowl shape. During the formation of the top, volume may gradually decrease, but as the price starts to fall away from the rounding pattern, increasing volume confirms that selling pressure is gaining strength. By incorporating volume analysis into your understanding of these chart patterns, you will be better equipped to confirm the validity of potential breakouts and reversals. Volume serves as a key indicator that can help you separate genuine moves from weak or false signals, ultimately giving you an edge in your trading. There is another important thing to watch for, and that is volume spikes. A volume spike happens when there is a sudden surge in trading activity. This is often a clue that something big is happening. When you see a volume spike near a key level of support or resistance, it is time to pay close attention. This could mean that large traders are stepping in. If the price breaks through a resistance level at the same time there is a volume spike, it is a good signal that the breakout is real and may continue. You can confidently enter trades in the direction of that breakout. But if there is a volume spike near support and the price holds, it might be signaling that a reversal is about to happen. Keep an eye on these volume spikes, as they are often great opportunities to enter or exit trades at the right time. When it comes to breakouts and reversals, volume really is the key. Let us take a closer look at how volume interacts with different types of breakouts and reversals to give us more insight. Breakouts happen when the price breaks through a key level of support or resistance, and volume is what determines whether that breakout is likely to hold or not. Have you ever seen a breakout that just fizzled out and went nowhere? Chances are that happened because there was not enough volume to back it up. A successful breakout needs the participation of many traders, which is reflected in higher volume. If Bank Nifty breaks through a key level and the volume is high, that breakout is more likely to succeed because it means there is enough market interest to support the new price level. This is why volume acts as the fuel that drives breakouts. On the other hand, a breakout on low volume is much more likely to fail and lead to a reversal because there is not enough participation from buyers or sellers to sustain the movement. This makes it essential to always check volume whenever you see a price breaking a key level, as it can make all the difference in the validity of that breakout. In the context of reversals, volume is also crucial. Reversals happen when a trend changes direction, and volume helps confirm whether this change is real or not. For instance, if the price is in an uptrend and starts reversing with increasing volume, it indicates that sellers are stepping in strongly, which makes the reversal more credible. Conversely, if a reversal happens with low volume, it could simply be a temporary pullback rather than a true trend change. When the price starts reversing and the volume is increasing, that is a strong sign that the trend is indeed changing direction. This volume-backed reversal can help you catch turning points in the market that can lead to high probability trades. For example, if you see a head and shoulders pattern forming and volume is increasing as the price moves through the neckline, that volume surge confirms the reversal and makes the trade setup much stronger. Another useful aspect to understand is volume divergence in breakouts and reversals. Volume divergence occurs when price movement is not confirmed by corresponding volume levels. For example, if the price is making higher highs but the volume is decreasing, it could be a sign that the uptrend is losing strength, potentially leading to a reversal. Similarly, if the price is making lower lows but volume is decreasing, it may indicate that the downtrend is weakening, which could lead to a bullish reversal. Paying attention to volume divergence is a great way to identify potential false breakouts or weakening trends, helping you make better trading decisions. By thoroughly analyzing volume during breakouts, reversals, and instances of divergence, you will be better positioned to determine which moves are genuine and which ones are likely to fail. This additional layer of analysis will help you filter out false signals and focus on the trades with the highest probability of success. Let us talk about some practical strategies you can use to trade Bank Nifty with volume. The first strategy is using volume for trend confirmation. If the price is rising and the volume is also increasing, that confirms the uptrend. But if the price is rising while volume is decreasing, it might mean that the trend is losing momentum and a potential reversal could be on the horizon. Another strategy involves trading breakouts. When price breaks a key level of support or resistance and you see a corresponding spike in volume, that is often a great entry signal. High volume during a breakout indicates strong market participation, meaning the move is more likely to succeed. However, if volume is weak during the breakout, it could mean that the breakout is not genuine and the price may revert back. In such cases, it might be wise to wait for more confirmation before entering the trade. For reversal trading, volume plays a crucial role in identifying high probability setups. When the price approaches a key support or resistance level and reverses with a significant spike in volume, it often indicates that the existing trend is weakening and that a reversal is beginning. This increase in volume confirms the shift in momentum, providing a good opportunity to enter a trade in the opposite direction. Another effective strategy is to combine volume analysis with chart patterns such as head and shoulders, double tops and bottoms, and wedges. When these patterns complete, the breakout or reversal needs to be validated by an increase in volume. This helps in confirming the reliability of the pattern and improves the chances of a successful trade. For instance, if you see a head and shoulders pattern breaking the neckline with increasing volume, it is a strong indicator that the reversal will hold. Lastly, using volume divergence can help identify weakening trends and potential reversals. If the price is making higher highs but the volume is decreasing, it could signal that buying interest is fading, setting the stage for a reversal. Similarly, if the price is making lower lows but volume is decreasing, it may suggest that selling pressure is weakening, which could indicate a bullish reversal. Paying attention to volume divergence allows traders to catch shifts in market momentum early, providing a valuable edge. There are also some specific volume indicators you can use to strengthen your analysis. One popular volume indicator is called on-balance volume. This indicator adds volume on up days and subtracts it on down days. It can be a great way to see if price movements are supported by volume. Another indicator is the accumulation distribution line, which helps track whether the stock is being bought or sold heavily. You can use it alongside volume to see if there is buying or selling pressure in Bank Nifty. Lastly, there is the volume oscillator, which compares short-term volume to long-term volume to help you spot changes in momentum. These tools can give you extra confirmation and help you make more informed decisions. If you really want to make your strategy stronger, try combining volume with other indicators. For instance, moving averages can help you confirm trends. If the price is above a moving average and the volume is increasing, that tells you that the trend is likely to continue. You can also use the relative strength index along with volume to spot overbought or oversold conditions. For example, if you see a high relative strength index along with decreasing volume, it might indicate a potential reversal is near. Another great tool is the moving average convergence divergence, which helps in identifying momentum changes. If the moving average convergence divergence line crosses up while volume is increasing, that is often a strong buy signal indicating a shift towards positive momentum. Another useful combination is to pair volume with Bollinger Bands. When price approaches the upper or lower band and there is a significant change in volume, it can help confirm whether the price will continue in that direction or pull back. Additionally, using volume with Fibonacci retracement levels can help identify whether pullbacks have strong participation, indicating a potential reversal. Using these indicators along with volume can help make your trades more reliable by adding multiple layers of confirmation, thus reducing false signals and improving overall confidence in your trades. Another chart pattern to be aware of is the ascending and descending triangles. Ascending triangles are bullish patterns that are characterized by a flat upper resistance line and rising support. When the price eventually breaks above the resistance line, an increase in volume confirms the breakout. This increase in volume shows that buyers have gained enough strength to push the price higher. Similarly, descending triangles have a flat lower support line and a descending resistance line, and they are typically bearish patterns. When price breaks below the support with rising volume, it is a signal that sellers have taken control, confirming the downward breakout. In addition to these patterns, we have the broadening wedge. This pattern is characterized by diverging trend lines, where the price makes higher highs and lower lows, creating an expanding formation. A broadening wedge can be either bullish or bearish, depending on the direction of the breakout. Volume tends to increase during the breakout phase, and this volume surge is crucial in confirming the reliability of the breakout direction. The three drives pattern is another advanced chart pattern worth noting. It involves three distinct pushes or drives in one direction before a reversal. For example, in a bullish three drives pattern, there are three higher highs, each accompanied by decreasing volume. This decreasing volume indicates that the trend is weakening and fewer buyers are willing to push the price higher. After the third drive, there is often a sharp reversal, typically confirmed by an increase in volume as sellers step in forcefully, signaling the end of the uptrend and the beginning of a reversal. Conversely, in a bearish 3 drives pattern, the price makes 3 consecutive lower lows, with volume decreasing during each drive. This indicates that the selling pressure is waning. After the third drive, a reversal often occurs. An increasing volume on the reversal confirms that buyers are stepping back in, leading to a trend shift. It is essential to watch for this volume confirmation on the third drive to validate the reversal and avoid potential false signals. We also have harmonic patterns, such as the Gartley and butterfly patterns. These patterns use Fibonacci levels to predict potential reversal zones. Volume can be an important factor in confirming these patterns. For instance, if the price reaches a potential reversal zone in a Gartley pattern and there is a noticeable spike in volume, it indicates that the reversal is more likely to occur. On the other hand, if volume remains low, the pattern may not play out as expected, and price could continue in its original direction. By thoroughly understanding these chart patterns and using volume to confirm them, you can significantly improve your trading strategy. Volume is not just an add-on to your analysis. It is an essential element that can validate chart patterns, help you filter out false breakouts, and increase your confidence when entering or exiting trades. Volume can also be useful in managing your risk. You can set your stop-loss orders just beyond key volume levels. If price breaks these levels with high volume, it might mean that a big move is happening, and you want to protect yourself. You can also adjust your position size based on volume. When volume is high, you can take larger positions because the moves are more likely to be reliable. In a low volume environment, it is better to take smaller positions since the moves can be more unpredictable. Of course, there are common mistakes that traders make when using volume. One big mistake is ignoring volume when there is a big price move. Remember, a move without volume confirmation might not be trustworthy and could easily reverse. Another mistake is overreacting to small volume spikes. Not every spike means something significant. Make sure to always confirm with price action before making a decision. And do not rely only on volume. It is powerful, but it works best when used with other tools, such as moving averages and trend lines. This way, you can make sure that your trades have the highest possible chance of success. To wrap things up, the volume indicator is a crucial part of trading Bank Nifty. It helps you confirm trends, identify breakouts, and spot potential reversals. Start by setting up your charts with volume and pay close attention to how volume behaves at key price levels. Remember to combine volume with other indicators to strengthen your strategy. Use volume spikes, breakout confirmation, and volume divergence to help guide your trades. And keep practicing. Over time, you will learn to read the volume like a pro and spot high probability trades with confidence. Feel free to ask any questions about what we covered or share your thoughts on using volume in Bank Nifty. Your engagement really helps everyone learn and grow together, so do not hesitate to join the conversation. Thanks for tuning in and happy trading.